ladies, and in case there are any gentlemen out there. So a very warm welcome from the heart, but the weather says all cool and chill. So we are really excited to host Arti, who's our very own member. She brings in more than 25 years of experience in this field. She's worked across marquee names, Deutsche, Standard Chartered, HDFC, and currently she's a partner with InCred. She's been advising people in the ultra HNI space. So I'm sure a few of you qualify there. That's 50 crores and plus investable surplus, to say the least. So we're all really looking forward to nuggets to grow our measly money into something large with Arti's help. Zia would be moderating the session. Zia is our chairperson, and this is something that's been really close to her heart. She's been the power behind the Financial Fridays series, and it is something that's got co-created with her. And as you all know, and hopefully we've been working towards this, as you can see, is the theme for the year has been engage, empower, and enhance. And I think we're strongly working through all our programs towards that. So I'll bring on the floor the two lovely ladies to take this session forward.
Thank you so much, Madhu, for your wonderful introduction. Good afternoon, everyone. To some of us, financial planning and wealth management seems like a daunting task. As more women get involved in the workforce and managing of household finances, we need to have the right tools and knowledge so that we can make the right decisions. Arti will decode some of this in her presentation today so that we may gain knowledge on how to address wealth management the InCred way. Also, we will have a short question answer session at the end, so please do type in your questions in the Zoom chat box. I am delighted to have Arti Wadhwa Bhalla with us today. Thank you so much for participating in this webinar and sharing your knowledge on the importance of wealth management. So let's go straight to the questions. My first question is, in your experience as a financial planner, how has the role of women evolved over the years?
Thank you, Zia. Thanks, Madhu. Wonderful to be with all of you as always. So I think I'd like to start by saying, as you all know, women have been excelling in all the areas, be it sports, medicine, governance, climbing corporate ladders. They have been winning the world with beauty and grace. They have even been landing in space and beyond, as you know. So that way we have all come a really long way in empowering ourselves. And in my personal experience as a banker and as a financial planner, wealth advisor over the last 25 years, I've seen now that more and more women are actively contributing to household income over and above their contribution to the house as homemakers. There are many women entrepreneurs, who are wanting to take their business to the next level. Startup, as we all know, is the buzzword. And happily, we're seeing inspiringly so many women-led startups. However, as you mentioned, Sia, and I think we touched upon it in the previous session, that, while women are learning to be financially independent, managing their own finances, growing their wealth is something that they are happy to leave it to the men in their lives. Generally speaking, not everybody, be it the fathers, brothers, or friends. And I really think that all of us women are actually very good. We just need to believe that at making better decisions on everything, whether it's purchasing, whether it's saving money. I mean, aren't we? We're just better at everything. So I just think that, it's very, very important that we learn to get more and more involved in our own financial planning. And it's really no rocket science. Like, we are happy to attend workshops on fitness, on anti-aging. Why don't we spend a little time? And so that's why it's wonderful that we're having this series here and, doing that. So the other thing that, there was a study that was done recently, which showed by a digital wealth firm only in the metros, which really showed that there has been a trend of women taking a greater control of their finances, and that's been accelerated by the economic impact of the pandemic. However, there's still really a long way to go.
Thank you so much for that, Arti. My next question is, why is it important for women to be actively involved in money matters?
So I'll just, like to share this slide here and, start with that. There are some needs which the basic requirement for saving and investing money is universal. It's not unique to women alone. However, there are some women there are some, just give me a moment. I'll just put on the slide. Can we have that slide? Or I'll just share it. Just give me a moment. Are you all able to see the slide?
Not yet.
Yeah, I think it's just started now.
Yes, there we are.
Are you all able to see it? All right. So there are some, as you see here, we just tried to depict a few. So while, the need for roti, kapda, makan, these are universal needs, the basics. And these are not gender specific. So why should the means to get these, be restricted only to one gender? Having said that, there are some situations, as you would know and see here, which are unique to women. For example, motherhood. When women get pregnant, they, have children. Many women tend to, take a break from their careers, take a sabbatical, or just take less hectic jobs. And from personal experience and from experience with clients, friends, I've seen that at that time, especially if one has been earning, you just feel that little crunch, which I don't think one should feel if one is planned financially better. That is one. The other thing, which again we hear about, and unfortunately we've heard a lot in the last couple of years, has been that, if there's death of a spouse, preparing for an unfortunate event, or even a separation, then one is again left with wondering, where does one start? How does one go about it? So these are the reasons why I think it's very important. And I think, why just the sad things? I think as women, when we are working hard and, we all want to just enjoy life, be happy. So, if you plan your finances well, keep your goals, you can always have some, money to fulfill your nani khushiyan, like maybe just going on a holiday with your friends, or just deciding to just take off anywhere, or maybe just buying that watch that you've been planning to for a long time. Or you could even have some bigger goals, some badi khushiyan, like, maybe buying a house, or, making that, investment overseas. So those kind of things is something which is really important. At this point in time, I would like to ask the audience a question. And that is, what does being rich mean to you? If I could have some responses in the chat box. Any more? All right. So interesting. So can we have the next slide? So as some of you have said, you know, I think being rich means different things to different people, right? One just wants to have the comfort of knowing that you have enough money at any point in time to do what you will. So you want to be able to spend time with your loved ones when you wish to. At certain point in time, you want to indulge in hobbies that you always wanted to, but not done it for want of time or money. Take that long cherished holiday, or when age just sort of feels like a number, you know, indulge in whichever hobby that you may have. So to really get this, you know, it's important to, you know, have your mind free of any stress. And that's where I'd like to say, I don't know how many of you have read the book, Rich Dad, Poor Dad, but this has been brought about in that, and also many other books. Very important question, tough question, something to ponder about. Is your money working for you, or are you working for money? Think about it. So this is what would really bring me to the next slide, where I'd say that financial freedom is having your heart and mind free of worry about the what ifs of life, which are in general there, but are more unique to women, as we spoke about some time back.
So that brings me to the next question. So how does one go about making a financial plan?
So what I'd like to say here is, you know, financial management or financial planning, which seems to be this huge thing, you know, which we are always scared of doing, is really very simple. Financial or wealth management is not different from management as we know it in the real world. So most of us, you know, have worked or are working in corporates, running our own businesses, or even something as simple as, you know, for many women, when you're running a household or with children, there's always something that you want to get to with what you're doing. And that first step is nothing but defining a goal, defining an objective. The next step really is devising strategies on how to achieve that goal. There could be multiple routes or strategies for you to get to that goal. So what we need to do is look at those strategies, pick the best strategy that suits you, and then implement that strategy, which is step 3. And after we implement the strategy, the fourth step is to monitor the direction in which we are going, just to ensure whether we are on track to achieve our financial goal. So these 4 steps kind of is the ongoing process, really, and something that we need to keep revisiting. But this would be really the starting point for financial management.
So how does one define the objective or goal? How does one start thinking about this?
So now this is a tough one. Defining a goal in wealth management would be, the reason I said tough is it's not tough, but there are multiple factors that would go into defining your goal. And the starting point really is that, you know, you need to sit down with a paper or a pen or an app, whatever we are comfortable with, and actually do our cash flow planning. So where we need to start is look at your current expenses monthly. You know, you could break it down weekly, daily, monthly, quarterly. Look at your current expenses. Then look at, you know, creating an emergency fund. While this would be different for different individuals, but in general, they say that, you know, 6 months salary or 6 months income, which you're getting from business, should be put aside and kept as an emergency fund, which you may need to draw on at any time. So it could be, you know, in a short-term deposit or a fund as we go along. And whatever money remains after that from what you're earning is what would go into planning for your future goals. And future goals would be different. They would be, short term, there would be long-term goals, really. So I'll just come to the next slide now. The other things which really influence our decision in the, in making the goals are, we need to look at where do we begin, that is one. And then the other thing is that when we say where do we begin, we also have to look at what are the changing dynamics. And the changing dynamics today, and again, the pandemic has been a learning lesson for so many of us, is that today there's a shorter working life. One, simply because you may not want to work for long. You want to retire at 50 and, enjoy life after that. Or alternatively, there's so much unpredictability in today's times. When COVID hit, so many businesses were adversely affected. Suddenly, business income, salary incomes were affected, because no one was prepared on how to handle it. So one needs to be better prepared for that. And another very important thing to look at is inflation, which is, to my mind, the most important thing while we are defining our goals. And the next one, of course, would be, again, which I spoke about briefly earlier, is the changing outlook towards retirement. People just don't want to save. Earlier, people wanted to save for retirement, like mostly for health needs. Today, people want to retire and do what they've not been able to do maybe in their early years, have an active life, fulfill hobbies like we spoke about really. So that's what it is. So now can we have the next slide? Yeah. I spoke about, sorry,
please go ahead.
So since we were just completing, I just wanted to complete the part about how to define the objective goal. And I spoke about inflation, here you'd see that, and I'll start with a very simple example. 10 years ago, a simple aloo tikki burger, a McDonald's aloo tikki burger, would have costed you 20 rupees. Today, 10 years later, that burger is somewhere around, I think, 49 or 50 rupees. So if you see, what's eroded is the purchasing power of money that you had 10 years ago. And that's what inflation is all about. So there is one inflation number which the government publishes, which could be whatever. One thing which we all have to note is that that's not the inflation that we're affected by, because that inflation account has 50% of it are components of food inflation. Most of us don't spend 50% of what we are earning on food. So it's important to see what inflation affects us. So the factors that affect us is what we call lifestyle inflation, where we look at, say, 20 years ago, what was the cost of education for higher studies in India or overseas. You look at having events, in premium restaurants or 5-star hotels. 20 years ago, what was the cost of maybe eating out in a 5-star hotel? It was maybe 1,000 rupees per head. Today, it's well over 10,000. Similarly, the cost of flights to London, to Bombay, to New York. So there was a study that was done, and that study showed that all, a basket of expenditures like this have grown over the last 30 years on an average at about 12% per annum. And as you can also see here, today, if your annual expense is 2.5 lakhs, after 30 years, you need 19 lakhs for the same expenses. And after 40 years, you need 36 lakhs for the same expenses. So the idea is that you need to increase the purchasing power of your money. If you have 2.5 lakhs today, that had better become 36 lakhs if you want to maintain the same lifestyle. That's what is important. And that brings me back to defining our objective. The first objective, most important objective, is to be able to beat inflation, the lifestyle inflation. So the returns you get on your investment should be, what I'm saying, anywhere above 12%. Otherwise, you're eating into money that you're earning.
So then what is the right time to start? And what are the key factors to keep in mind while making a financial plan?
So the right time is a good question, because the right time is yesterday. The right time is now, and I'll just share the next slide, where what we're saying is that if we are, not saving for a year or investing for a year, you're going to have to work for another year. I'll just put out the next slide. Just give me a minute. Yeah, so you could see this here, that most people actually start to plan for their retirement when they're 49. That is a little late in life. Like I mentioned earlier, each year of earning should really contribute to each year of your retirement. So I'd say at 32, plan for 62. At 40, plan for 70. That's how I'd like to say it, So like to answer your question, you should really start now.
And what do you mean when you say asset allocation?
So putting it very simply, asset allocation is diversifying across asset classes. We hear very often, don't put all your eggs in one basket, right? So asset allocation is just a fancy term, if you would, for that. And broadly, while there could be many definitions of different asset classes, but broadly in the financial world, there are these 4 asset classes which we talk about. There is debt, there is equity, there is gold, and there is real estate. So I'll just touch a bit upon each of these. Debt would basically be things like the constituents options would be things like bank deposits, company deposits, debentures, private or government bonds. There could be things like PPF, national savings certificates, So mostly instruments which tend to give you a fixed return or a quasi-fixed return, like a range, over a period of time. However, just to give you an idea, currently all fixed income options in India or debt options in India, you're probably going to be getting a return in the range of, say, 3 to 7 at best. Unless you take undue risk, you could go to maybe 9%. This I'm talking of pure fixed income or debt returns. So there again, one thing I'd like to say is, while there's nothing wrong with it and debt is important, it is not going to help you entirely to beat your inflation. And that's where you need to bring in equity. So equity as an asset class is basically anything and everything to do with the stock market. So you could look at investing in stocks directly. You could look at investing in mutual funds that invest in stocks. There are other options, which I don't think time would permit us today to talk about, but there are portfolio management schemes. There are alternate investment funds. All of these, the PMS and the AIF is something that, we can only start at higher levels of 50 lakhs and above. And I think, Zia, you mentioned you'll be having other sessions to cover those. So for this point, I'd just like to touch upon that. So equity as an asset class is something which, if you can invest for a longer period of time, like 3 years plus, can help you beat inflation, because that's where we hope to get returns in the range of 12 to 14% at least. Then let's look at gold. It's become very popular, especially during the pandemic. I mean, we as Indians all anyway invest in gold. Our mothers, all Indian households have so much of gold jewelry. However, we don't count that part technically as investment, because that's not something which anyone's really going to liquidate, God forbid. So what's happened is there are some alternate avenues of investing into gold. There are gold mutual funds, there are gold exchange traded funds, and something that's become very popular in the last few years is the scheme introduced by the government, which are the sovereign gold bond funds. So these are in these bond funds, you can have it with any bank and you can invest in it. It's a fixed thing for a period of 8 years. You'll get 2.5% per annum. And then when it matures, 8 years later, whatever is the value of gold, up or down, you'll get that. That's how it works, just touching upon it briefly. And then, of course, you have real estate. So real estate is the house you're living in. Over and above that, you could invest in real estate, in apartments, in land for the purpose of appreciation. And there are, of course, real estate funds, but there are very few in India, and the real estate regulatory authorities are being set up, but I think we're going to take a long time to get to where the Western world is, but it's all started. So this is about the asset allocation. And I just like to say, like I said earlier, can I have the next slide, please? Yeah. So as you can see here, you know, in the short term, debt instruments such as fixed deposits, debt funds, bonds, they'll give you lower returns like 4 to 8%. So what happens is there is lower volatility, as you can see on the left, but inflation weighs heavily. And in the long term, as you see on the right, you know, equity may be more volatile, but that's what will help you beat inflation. So many a times, you know, people say, we don't want to take the risk and invest in equity because, you know, I may lose capital. But as Mark Zuckerberg has said, you know, the biggest risk is really not taking any risk. So to achieve our financial goals, we need to have allocation to debt and equity. We could have more weightage to debt to achieve our short-term goals. We could have a higher allocation to equity to achieve our long-term goals. So I've just sort of tried to show that here, that money you need, you know, when we're doing our cash flow planning or bucketing, as we call it, money that you need for a period up to 6 months should be kept, you know, either in liquid debt mutual funds, short-term fixed deposits, rather than just keeping it in the bank account, so that it's earning something and you can withdraw it at any time that you need it. Money that you would not need, say up to 3 years, from 6 months to 3 years, should go into some of the other things that I spoke about, you know, the debt funds or corporate bonds, government bonds for that tenor. And money that we don't need for 3 years or more should most definitely go into equity, because that is what, like I told you earlier, will help you beat inflation. So depending on the time horizon, liquidity requirements, we need to do this bucketing exercise and balance the asset allocation between the different asset classes. I'd just like to show you this little graph here just to explain this in greater detail. So as you can see on this quadrant, just one second, just put on the other slide, yes. So as you can see, the lowermost quadrant, we've got bank FDs, company FDs, bonds, debt mutual funds. But if you see on the left spectrum, on the side, you see the returns would be only 4 to 8%. So you're low on risk, but you're low on return. As we move along the risk return spectrum, we go into equity mutual funds, which would be slightly higher on the risk, but would also give you higher returns. There's also something called structured products and debt, structured products and equity, which is a quasi, which is a mix of the elements of debt and equity. And there's also something called balanced funds. So in the interest of time, I'm not getting into more details on this, but this is just to give you an idea on the type of options that you could look at as umbrellas for investing.
So then, Arti, could you just explain to us exactly what are mutual funds?
Yeah. So mutual funds are very simply put, you know, there are these professional fund managers. I'm trying to make it sound simple. There are these professional fund managers whose only job is to study corporates and avenues for investment, and for a living, that's what they do. Identify companies basis a lot of factors, you know, a lot of detailed research, technical, fundamental. They are the ones who actually invest money given to them by the investors. So what happens is there's a group of investors, you, me, and public at large, who pool in their savings. Then they give it to the fund managers, and the fund managers as a pool. So for example, each of us may have given 100 rupees, and there is a sum of 1 lakh which they have as a pool to invest. So they invest that 1 lakh rupees across, say, 10 securities, and the weighted average price of that security or the unit of that mutual fund is got a price at the end of every day, with whether it's a debt mutual fund or an equity mutual fund. And that is what we call the net asset value. So that's the price of that mutual fund for that day. And over a period of time, these mutual funds, depending on whether they are debt or equity, they are of different types, as I mentioned, will give you returns, and those returns come back to investors. So you could take that in the form of dividends, or you could just leave it there, let your money grow and pull it out when you require. So this is just a graphical representation. Some of the other benefits of mutual funds can be seen here. This is an avenue for saving. And for someone who's starting out, because I think I saw one question in the chat box, and I'll probably answer that later. But for someone who's starting out for the first time and must have investment in equity and debt mutual funds, I would think it may not be such a good idea, unless you have a very good understanding or a very good advisor on the stock market, to go directly into stocks. So equity mutual funds will actually be affordable because there's no minimum amount there. You could invest with as little as 5,000 rupees. Then the other thing, the benefit that mutual funds give you is they help you diversify. So that 1 lakh will actually be split across some 50 companies. So that diversification, spreading your risk across companies, helps give you better returns. There's professional management, there's transparency. Mutual funds are very well regulated by the regulators like SEBI, RB. There are many RBI, there are many rules that govern them and ensure that they're liquid. So the best part about mutual funds is that, if you've invested in a debt mutual fund, I think you can, depending on what type, most of the debt mutual funds, you can get the money in a day's time. So if you tell your advisor or put in a redemption instruction online today, you'll get your money in your bank tomorrow morning. That's how simple it is. And for an equity fund, you'll get your money in 3 days' time. So that way, debt and equity as financial assets are better asset classes to be in than gold or real estate, where if you do require liquidity at short notice, you don't have that.
And what exactly is an SIP?
So an SIP is really, putting it very simply, it's like, I think when we were all growing up, I mean, unless there are too many youngsters here, I don't know. But when we were all growing up, our parents, would sort of put aside this money every month, like a recurring deposit, like a fixed amount every month, so that, when we go to college or we get married, they get the, you get this lump sum, which they can use for at that point in time. So a systematic investment plan is actually just investing a fixed amount at predetermined intervals to use the market fluctuations to your benefit. So you could actually have an SIP in both equity or debt funds, but it makes sense to do it in an equity fund because, so it's as simple as this. You could invest 5,000 rupees every month over a period of 3 years. I'll just share with you how it looks. So if you invest 5,000 rupees every month. Here I've taken both the scenarios. 5,000 rupees invested every month for 5 years. After 5 years, you'll get, and here I've looked at 2 options, so if the markets tend to be giving a lower return of 8%, you'll get a 3,64,723. And if you're getting a return of 12%, which is what would mostly happen, you'd get 4,0706 rupees. And ideally, an SIP makes sense, over a 15-year period, because that's what you're looking at for your long-term goals and beating inflation and all of which we spoke about. So something as little as 5,000 every month will yield a corpus of 23,57,289. And I think today most of our kids, and I'm just using this opportunity to touch upon it, because while we are women here, I think we learn to invest ourselves. It's also important to teach our children, boys or girls, to start saving and investing at an early age. And I do know of parents who now start telling their children at age 10 and 12 to start saving, because there's so many apps now for investing and these kids understand it better. So it's always good to tell them at an early age to start saving a portion of their pocket money. It helps to inculcate that habit of saving regularly and saving for the future. So that's what an SIP will do for you. And here, let's look at a little larger numbers, since we would have different people of different age groups in the audience. Let's say we look at the case of Mala, just taken names as an illustration. If Mala has an expense of 28,000 rupees a month, and she's 30 years old, and I've taken the retirement age as 65 here, the inflation adjusted expense for her would be 1,54,000. And for her at this expense, accounting for inflation, when she retires at 65, if she stops earning, she would need 3.1 crores. So to get to that corpus, what Mala would need to do is put in 8,142 rupees every month as an SIP. Similarly, someone who is 45, Bindu, has a monthly expense of 45,000 rupees. She would need to be able to get a corpus of 2.4 crores. She would need to be investing 31,000 rupees every month as an SIP. So obviously, coming back to that question you asked, Zia, when should we start? The later we start, the more we need to save and the more we need to invest. So the sooner we start, the better it is. And that's why I said start yesterday.
So should financial planning be done according to age group?
Well, yes and no, because this is again a discussion which could take a long time, but putting it very simply, every person's requirements and needs are different. So what happens is that every person needs to have an individual personalized financial plan. But having said that, generally speaking, we look at the financial life cycle in this manner. We look at, the early years of one's life, as you see on this graph. When you're single, you don't have that many commitments. You're just sort of taking care of your day-to-day expenses, living. That's what we call basic wealth protection. Then as we move along, people who get married, have children, have other commitments, maybe taking care of their parents. That's where we get into a phase of wealth accumulation. And then as one starts to approach the retirement years, that's when, you need to start planning for your retirement. And when you are actually retired, then you start thinking about transferring the wealth, and you think of things like writing a will, succession planning. That stage is called wealth distribution. So that's where, generally speaking, and as you can see in the next slide, we've just sort of tried to say that, these are the 4 or 5 different age groups where maybe there could be certain similar requirements. So the younger age group, like I said, when you're 25 to 34, your aspirations and requirements in life are different. A working parent in the age group of 35 to 44 will be thinking about higher education goals for their children, their own retirement planning. And then as you move into midlife, you probably start thinking more about healthcare, your parents' healthcare expenses, and so on, basically. So that's the reason why there is this, generalization. But as you would see, even from the next slide, and this is something we discuss in the financial world, the general rule people say is that you should put in equity an amount which is 100 minus your age. So while this rule is fine to talk about university. So which really means that if you're 40, then you should put 60 into equity, because it's 100 minus 40. So you should put 60 into equity, which is where you're somewhere in the age group of age 35 to 55, where we're saying 60% into equity, 40% into debt, because we want to achieve a higher return. So while this does work universally, what's happening is in the current scenario with debt not giving us that much of returns and, expenses and inflation going up, when we do personalized financial plans for clients, we bring them back to what I told you about earlier, that, do your bucketing. Money which you don't need for 3 years or more can be put into equity. So that way, I could even have a 70-year-old man, supposing he has enough to take care of his day-to-day expenses and he has more money. Just because he's 70 doesn't mean that he has to put everything into debt, because he may live till 90 and he wants his money to work smarter for him, or lady, same thing, So given that is where I said that while we can't generalize broadly, these are the universal rules which apply.
And what would your advice be for single women who are running their households on their own? How do they save as well as maintain a certain lifestyle?
So this is an interesting question. I would like to split this into two, For single women, the goals would really, be different depending on the age and stage of their lives. And single women could be single women and they could also be single moms, And so I just start by saying that the risk appetite of women in their 20s would generally be different from those in their 50s. So 20-year-old single women should be focusing on investing for financial goals, which could be things like higher education, buying a house, maybe planning a fancy destination wedding. That's pretty much in vogue if they wish to. So while you're young, you should enjoy your income. But I also think it's very important to be conscious of avoiding wasteful expenditure. And it's important to, keep because that's something which we see with the younger generation. They just sort of believe in living for the day, living on credit cards and all of that. Hence, important to reiterate that it's important to save also for the future, because as we saw, to keep up with lifestyle inflation, they will need considerable savings to achieve your goals. And on the other hand, an older single woman will probably look at, saving for her retirement, for health insurance, building an emergency fund. Then let me come to single moms. Single moms obviously will be more focused towards raising her children. She must not, however, forget for her retirement is just as important. So investing in keeping retirement, children's education, higher education, her own future, she has to keep in mind. And some of these mutual funds and also insurance have certain lock-ins and maturity date, should be considered for children's education and long-term expenses. And as I had already mentioned earlier, very important for single women also, mothers and otherwise, to keep a emergency fund handy.
And what would your advice be for married working women who actively contribute to the household income in terms of building assets as well as in terms of saving for their children's education?
So, here there is a benefit. For married women who are working, they clearly have a benefit as a household of a dual source of income. So expenditure and investment goals should be divided in proportion to the earnings. And there needs to be a clear demarcation. So for example, the husband, and this is just an example, the husband could probably take care of, monthly expenses, could be loan EMIs, could be rent, could be utilities. Wife could maybe look at spending money on family entertainment, other miscellaneous expenses. And then whatever are the household savings after taking care of the expenses, that should be invested keeping in mind the short-term and the long-term goals. So both the husband and wife should actually have monthly SIPs for different goals, like maybe children's education, buying a house, medical expenses, and retirement planning. That's broadly how I would suggest it. So of course, when I started working, I always like to tell my husband, and it doesn't work like that, is that my money is my money and your money is also my money. Doesn't work like that though today.
Thank you. And that brings us to our last question, which is, could you briefly touch upon insurance? You know, I know we're running out of time and insurance is a huge field, but if you could just briefly touch upon it, I think that would be helpful.
Sure. So, insurance insurance is very important because you need, this is just a small slide to show that, but basically you need insurance for peace of mind. And broadly, I know you're going to have another session on insurance and it's a big topic in itself, but the two basic forms of insurance one should look at taking, and I'm sure most of us have it already, but should look at adding to it, is health insurance. And, and that's what the pandemic has taught us too. Enough health cover for the family, all members, and also life cover. And life insurance in general, there are various options, but I'll just touch upon to say that the best form of life insurance is taking a term plan. Most advisors, especially banks, will not tell you about it because unfortunately, not naming any, having worked with so many banks, private or foreign, there's always this pressure to sell insurance or rather mis-sell. So what happens is that they tend to sell you insurance as an investment, whereas as an advisor, I always say that keep insurance and investment as two separate goals. And when you keep that separate, it always just makes for better financial planning to achieve your goals.
Thank you. I think we will now open the floor to audience questions. So please put your questions in the chat box. I will begin with some questions. So as a beginner investor, what is the best online platform to sign up to start the investment journey?
There are many actually. I don't think it's going to be very fair to take names here, but there are many, but some of the popular, I think if you're currently investing through a bank or any wealth advisor, most of them will also have their own with their online platforms. And, basic things like investing in stocks or mutual funds, I think everyone's good. But I think what's really become popular over the years, especially for stocks, is Zerodha. There are other platforms which are growing like Grow, Stocks, and that there are quite a few.
Is there a minimum quantity of shares that one must purchase for every stock? And no. Given the volatility of the markets these days, is it a good time to enter the market and hold on to stocks for a longer term? And what would that longer term period be?
All right. So minimum quantity of shares, the answer is no. If there is a share of a company that costs you 50 rupees, you could just buy one share. When you go online or through your broker or advisor, you can just, so there's no minimum quantity as such, and when you're saying stock here, I'm presuming, that you're talking about shares. And all right, so this is a topic that would take up a lot of time, but I'd just like to say, in the interest of time, given the volatility of markets these days, it is a good time to enter the market. Yes, it is a good time. Markets have corrected about, I'm talking about equity, have corrected nearly 12% or more from the peak. And nobody would really ever know, when I say nobody, I mean nobody would know where the bottom of the stock market is. So what we advise clients, investors is that yes, there is volatility. You may want to wait it out for a bit, but don't wait forever. To give you an example, most recently, and most of you would remember, when COVID hit, many really thought the world's coming to an end, and markets crashed from the period March of 2020 till June of 2020. And everyone, if not everyone, most people thought that it probably take 5 years, 10 years, God knows, to come back. Life had come to a halt. People's careers were impacted, jobs, health. There was so much at stake, not just in India, everywhere, all over the world. But what changed was central banks came to the rescue, started printing money and started doling out easy money to the countries. Same thing happened in India. And nobody ever thought that in the next 15 to 18 months, not just in India, but globally, stock markets reached their all-time highs. We're still not out of the pandemic. So nobody really knows. So it's always best to start investing whenever the market dips, small amounts. So I can simply say that, if you have 100 rupees to invest in equity, invest it over the next 6 months, either through an SIP or through an STP, which is very similar to that, where you could put your money into a liquid or a short-term fund and keep putting that 6 intervals, 6 equal installments over the next 6 months.
And what exactly is debt?
I think there's another question there, Zia.
Oh, sorry, have I missed?
No, I just happened to see it, and obviously it's close to my heart because
yes, is it better to have an investment advisor or a fund manager? Sorry about that.
No, that's fine.
Yeah.
So I would say that if you have the time to follow the markets, to do your research, on stocks, funds, and, you can sort of spend a few hours every day reading up, following the market trends, then maybe given the online platforms today, you don't need an investment advisor. But I'm not saying it simply because I'm an investment advisor, but I'm just saying that over the years, I've tried to teach and educate so many of my clients and friends about the basics of investing. But what does happen is while they understand their day-to-day jobs, whether it's housework or their business or jobs, doesn't, allow them time to monitor and watch the markets. And especially in these times, it's very important to, once you've taken your financial decisions, made your strategic goals, you do need someone to keep monitoring it. But it is important for you to understand everything so that you can work closely with your investment advisor, fund manager, be involved in the decision making. So I would definitely think that it's important to have an investment advisor, whether online or in person. That's your choice, but it's important.
Please explain what exactly is debt.
So what exactly is debt? I think I touched upon it earlier, but I just like to say debt is an asset class. And the connotation of debt is that it is fixed returns, safe returns. And what is happening, especially since the pandemic started, and it may change now, but we all went into a low rate regime. And anything which is to do with deposits, like maybe bank FDs, corporate FDs, bank debentures, your public provident fund, national savings certificates, RBI bonds, all these different options is what is debt. And within mutual funds, there are debt mutual funds, which again go and invest in a basket of these securities. So you could have most debt mutual funds investing in a mix of corporate and government bonds, So that's what debt is. I don't know if that answers your question.
How do you need to account for taxation on returns from investment?
So taxation is another big topic, but what happens is it would depend on your tax slab. But the good thing is in India, I mean, of course, it was better 3 years earlier, where there was zero tax on equity in the long term, which meant that if you invested in equity for a period of 1 year or more, that would be long term, and long term capital gains tax was zero. However, about 3 years, 4 years back, the budget introduced because equity markets were doing so well and government wanted to have their share of that. They levied a 10% tax on long-term capital gains. And so that's 10% today, regardless of whichever income tax slab that you might be in. And for short term, that is anything less than 1 year in equity is 15%. On the other hand, for debt, taxation is a little complex because that depends on the income slab that you're in. So for example, if you're at the highest income tax slab of, 42% plus surcharge, you will have to, and let's say you have money invested in a bank FD, you'll probably be getting a negative rate of return because a bank FD today will give you 4.5 or 5%. There'll be TDS 10%, and the remaining 30% will also be taxed. So obviously people at the highest tax slab, it makes more sense to be in equity or equity kind of. I hope that helps.
Arti, what about saving for holidays, fun and recreation? How does one budget for all this?
Like I said earlier, yes, that's very important. And, you should. So if you're planning to take a holiday in the next 6 months, that is something you need to probably set aside every month. So depending on where you're planning to take a holiday, you need to save that money every month and put it into a liquid fund or a short-term deposit. But if you're planning a holiday, say 2 years down the line and, or 3 years down the line, then you can definitely put in about 70%, depending on, again, one has to work backwards, how much you want to spend, how much, you want to save. Then if the holiday plan is say 2 years later, then some component can go into equity, remaining goes into debt, and you can plan for that holiday. And there could be so many things. Like I said, each one's wish list is different.
And that brings us to our last question is, please cover health insurance and what is the amount suggested?
So, health insurance amount suggested, it's a function of many factors. So if you want to take health insurance only for yourself, then it would be linked to one, of course, your age. Second, the health cover, the amount that you want to take. So just to give a Arbid example, for somebody who wants to take, a health insurance of say, a cover of say 50 lakhs, and someone who's about, 30 years old will probably be paying somewhere around, very rough average, 30 to 40,000 a year. And again, there are so many things, because it would vary from policy to policy, company to company. There are many factors. Every health insurance policy will cover you for the basics. Then there'll be certain other ailments that it may or may not cover you. There are riders. So it's like that. And then in health insurance, there could also be, and that's what makes a lot of sense, is to take a floater policy. So that covers the immediate family members, whether it's parents or husband, wife, and children. So you take a general cover of say 50 lakhs, and God forbid, should someone need it, it can be used for any of the 4 family members.
Thank you. Thank you, Arti, for explaining everything so beautifully. You've simplified everything so wonderfully, and I'm sure everyone has benefited greatly from our session today. I would like to now invite Madhulika Makkar for the closing remarks. Over to you, Madhu.
Great. That was an awesome session. And all the time I was thinking of the what ifs. I seem to have missed all the what ifs. So I don't know about the ladies here. I think asset allocation was beautifully covered. And yeah, the other thing that was making me really feel sad was like I had to start at 30 to retire at 60. Doesn't look like I'm retiring anytime soon. So thank you so much, Arti. Thank you so much, Zia, for moderating this session so well. A word of thanks for CII, the Secretariat, and the whole audience, and of course, our whole IWN community. Fantastic to have all the talent in-house. Hope to see these series cover a lot of other areas and get us all literate out there. Thank you so much.
Thank you. Thank you.